Lucas here, one of the Lucas ladies of eXp Realty, proudly serving the DMV area. Yes, yes. So in today's video, we're going to be talking about how to buy a home while self-employed. So all my hustlers out there that want to be homeowners too, this video is for you. Now let me give you a pro tip when it comes to these taxes. So when you are gearing up to buy a house, it is imperative, I cannot stress it enough, that you write off as little as possible. Yes, I said as little as possible. I know you like, girl, you crazy. I know. As business owners, we love a good write-off job, okay? Myself included. But let's look at it this way, guys. If you made, let's say you made, just for example, let's say you made $150,000, right? But you wrote off $100,000. So now on paper, and more importantly, to the mortgage companies and to the private lenders, it looks as if you only made $50,000. And that $50,000 is the number that they're going to use to determine what you are pre-approved for, meaning that it's going to significantly impact your purchasing power. And that is not what you want. Trust me, it's not. Because the thing is, you can always go down, but you can never go up, right? And what I mean by that is, let's say that you get pre-approved for $500,000. You're not obligated to spend that whole $500,000. You can go out and buy a house for $300,000 if you like. But if you're only approved for $300,000, you can never go up and go out and buy a house for $500,000 unless you plan on paying the difference out of pocket. And if you got that kind of money, it's like I'm playing. Well, just a little bit I'm playing. But no, all jokes aside, you want to make sure that your taxes most accurately reflect what you actually make, because that's going to determine what you get pre-approved for. And if you live in a lavish lifestyle, you make a big bank, you want to pull up to a house that reflects the hard work that you put in. You don't want to have to downgrade based off write-offs. No, that's not what we're doing. And then, honestly, the truth is, after you buy your house and everything is said and done, you can always go back and have your taxes revised and get your write-offs back. So just think of it as a short-term hit for the long-term benefits, okay? That is the mindset that we're having with this. Okay, so now let me prepare you. When you go to the lender to apply for your mortgage, they're going to want to see at least 2 years tax returns, including your 1099. They're going to want to see 2-month bank statements. They're going to ask you for your social security number so that they can do a deep dive into your credit. And they're going to be paying close attention to the score itself, your debt to income ratio, how much you make versus how much you owe, how much do you have to pay out. They're also going to be looking for any red flags such as frequently missed payments or repossessions. Now, a lot of times they're going to be wanting to see your financial records for your business as well. They might ask you to see your 2 years tax returns for your business. They may ask you for your Schedule C's or your Schedule K's. Just make sure that all of your finances for your business is in order as well. I can't tell you exactly what they're going to ask for your business because every business is structured different and the payment is structured different, and all of the business forms are going to be on an if applicable basis. So it really just depends. But make sure it's in order. In case they ask for it, you want to make sure that you have it, or otherwise it can really hold up your process. And that's the last thing that you want, honestly. You also want to make sure that you have a good amount of money saved and that credit is on point. I suggest saving 3 to 5% of your desired purchase price or range. It's really rough numbers, y'all. Then I also suggest that you have a 780 or higher credit score. Now, you can get approved for a loan with a lower score. But the higher the score, the better interest rates you get and the better opportunities you have to receive program money and things of that sort. And you really want to have everything that is available to you. You want to be in a position to get it. So, there is a less traditional route that you can go to secure a mortgage. There is a loan out there, depending on where you live, it's called different things. Most people refer to it as either a no-doc loan or a bank statement loan. And what that is, it is a loan where they use your credit score and a few years of your bank statement to calculate a yearly income, which they would then use to determine your pre-approval amount. And this is done in place of submitting your tax returns and all of the forms that I said you would previously need. Okay? Now, keep in mind, only certain lenders are qualified to do these type of loans. Where I live at in the DMV area, there are not a lot of lenders at all who do these loans, especially post-COVID. There's even fewer lenders who offer this type of loan. So let's talk a little bit about the pros and cons of using this loan. I'm gonna start with the cons and then add some sugar on top of the pros, okay? So, the cons to the loan is that you're automatically, when you use this loan, you go this route, you're automatically disqualified for any program money. So, no help with down payment assistance or anything like that. You get no money from the state, honey, okay? None. Another kind of con, depending, which can be a pro for some, is that with this type of loan that you're required to put down on average 10 to 20% of the purchase price, most of the times 20%, I'm not gonna lie, versus when you go the traditional route, you're only required to put down 3 to 5% on average of your purchase price. But a pro, adding the sugar now, y'all. A pro is when you put down a 20%, you will definitely get a lower mortgage rate, of course, because you put down more. Not a mortgage rate, a mortgage payment. Your mortgage payment will be lower because you put down more money. And because you have the 20% down, you're not going to be required to get mortgage insurance. Mortgage insurance is typically for the lender anyway. And it's typically a couple $100 added to your mortgage amount depending on how much the home is. So you'll save money that way, so you'll definitely get a lower mortgage payment. In my opinion, I think that this loan is perfect for someone who has been in business, is making a killing, has an influx of cash, and their taxes aren't necessarily all the way up to date. They don't need no help, no nothing. They got it, okay? This loan could be a perfect option for you if that is the position that you're in. If that is not the position that you're in, then you really want to set yourself up to be able to go the traditional route. But I really encourage you all to explore all of your options before committing to a loan type, because real estate is really not a one-size-fits-all business. Things are different for everyone, and you really have to just always trust your gut and do what you feel is best and right for you in your specific situation, okay?